Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending November 20th, 2020. I'm Preston Brent. Thanks for tuning in. Remember, don't be a rat brain trader. You want to be the red striped zebra. Stand out from the crowd. This week's theme, well, a vaccine put for the markets. That's kind of what I'm seeing right now. But let's just kind of take a look at where we've been, where we're going, and then we'll take a look at some of the charts here. So the first thing I wanted to talk about here is just a little bit about the market performance for the week. Okay, so if we look at the U.S. market, you'll see that the Dow and the S&P were in the red for the week. The NASDAQ was up a little bit, and the Russell is still continuing to be the strong runner, playing catch up. Since the last all-time high up until just recently was in September 2018. Year to date, we're all in the green, guys. The leader, of course, is NASDAQ with a technology just blowout this year, 32.12%, followed by the S&P a little over 10% up. Then the Russell has actually passed the Dow. It's moving up pretty quick. In fact, it's running neck and neck heels with the S&P. It's up 7% for the year. And the Dow bringing up the rear at 2.5%. And you can see from a sector performance standpoint, this week energy is still, it finished first last week. It's up this week too. It's up 5.6%. Utilities bringing up the rear at 1.78%. And the sector performance for the year, again, technology leading the way at 32.36%. Very similar to what we're seeing in NASDAQ there for the year to date as well. Energy bringing up the rear, but it was around 50% underwater. Now it's only 37% underwater. So it's playing fast catch up. And if you look in the upper right box, you can see valuations and volatility. The PE ratio, you can see the trailing 12 month is 40.73. The forward is 25.51, still very high. It's lower than the trailing by about 37%, but it's still very high. The dividend yield for the S&P dropped just 1 basis point to 1.69% annually, and the 10-year Treasury is at 82.9 basis points. The spread between the two, 86.1 basis points. So we still have a wide enough spread that still attracts money to the equity markets. And you can see the VIX actually moved up just a little bit for the week. It finished the week at 23.7. Now, if we look at the international side and just kind of see where internationally the major indexes perform, you can see this past week everybody was in the green. All right, leading the way was the Paris index, the CAC 40 at 2.15, followed by China at 2.04. And then we have everybody else, right? Year to date, there's only two in the green. Asian markets, really, the Nikkei, which is the Japanese market, up 7.9%, and China up 10.74%. But Europe is still hurting. We're still in a official correction territory for Great Britain. That would be the FTSE, down 15.79%. Now, they're working on their Brexit. Who knows where that's going to go? But I suspect they'll probably figure something out. They've been running this thing since 2016, so it's time they put that behind them. When they do, the British pound is going to go straight up, and I would recommend being bullish the British pound on that. Okay, the CAC 40 still down. It's not in correction territory. It was below 10% the prior week, but now it's only down 8.07%. Hang Seng, the Hong Kong index at the bottom, 6.17% red year to date, primarily because China come in and just kind of taken over that country. Now, if we look at the sound bites for the week and just kind of see where we are, let's start with the market performance. As I said, major indexes were fairly mixed. We had a couple good, couple bad, but good news on the vaccine front is kind of offsetting some of the worries about the worsening of the pandemic in a lot of the U.S. And that's what I meant by the put, the vaccine put. It's almost like a Bernanke put or a Power Ranger Boom Boom Powell put, where the Feds always step in when the markets crash. So even though the markets are neutral to slightly weak right now, we're not seeing too far of a move lower with the vaccine just hanging out there, which we know is going to get emergency approval in the next week or so. First Pfizer, then Moderna, and then they're going to start shipping about 20 million of them out to the really needy. And then next year is going to be the mass distribution. So that's pretty good. We're also seeing this past week, as I said in the week before, energy shares are outperforming Oil is rising on hopes for an end to the pandemic with the vaccine. And we're also getting signals that OPEC and other major oil explorers are going to delay production increase in January. Okay, so that would continue to build or reduce inventory levels and continue to put some upward pressure on the markets. Okay. One other thing I wanted to point out, though, portfolio managers in a B of A survey about a week or so ago, they're the most overweight equities, which means they're more bullish equities than they've been since January 2018. And I don't need to remind a lot of you guys what happened in February of 2018. We had one of the largest volatility spikes in the history of the markets up until that time when the markets crashed, right? When everybody gets bullish, you tend to recognize there's going to be a near-term market peak. When everybody's bearish, it's just the opposite. The other thing, excuse me, portfolio managers also cut cash holdings to their lowest level since April of this year. So understand we're getting a lot more people wanting to play bullish, and it tends to represent a short-term peak. I didn't say long-term, I just said short-term. The spread between the bulls and the bears also exceeded 40% in this B of A survey, meaning 40% more bull than bear, and that tends to show an extreme level of exuberance as well. And then finally, in the Gartman letter, which is no longer published, but Dennis Gartman put an email out basically saying that the ratio of insider sales to purchases exceeded 58-1, which is also consistent with interim market peaks. Now, we're getting some other things that are coming out there. And for our members, tomorrow evening in our weekly market watch, I'll show you kind of what the market breadth is doing and where we're sitting. But we are seeing a little bit of a cause for just near-term weakness. Okay. But I'm also looking at this as an opportunity in 2021. And members, we'll go through that this Sunday evening. COVID expansion also here in the U.S. and over in Europe. You know, as the pandemic is continuing to drag on the economy with a lot of governors, mostly Democrat, shutting down their states, right? I mean, they're shutting down the states, closing stuff up. We're seeing case counts rise, hospital systems getting a little bit more stressed. So the sentiment seems to be putting a little bit of a blow on the markets midweek, which kind of moved the markets down. And we also saw New York City public school system, which is the United States' largest school system, switching 100% to remote learning, which I think, again, is a mistake. They're clearly not following the science, but de Blasio, as most of you know, is probably one of the worst mayors in the history of mayors in the United States. He's an idiot. But either that, this is just kind of where we're sitting right now. And it also appears unlikely, at least through the end of this year, that we're going to have any substantial fiscal stimulus that's going to help folks, that their money is going to run out in 3 to 6 weeks, and that's going to hurt chances for more spending. All right, so chances of a bipartisan agreement for a new stimulus appear slim right now at this point in time. Okay, so that's a little bit about the COVID expansion. Now remember, I did say a vaccine put because it's preventing the markets from really coming down hard, because that's going to improve consumer sentiment once we get this vaccine out there. Now, if we look at the economic data, as I said, it's kind of provided more evidence for the Fed's repeated caution in the markets. The weekly jobless claims rose for the first time in over a month. It went from 711,000 to 742,000, and it's going to, stay weak as continuing claims, although are continuing to fall. It fell from 6.8 to 6.4 million. Although the drop was kind of offset by the rising claims for a federal program providing extended benefits. All right, so retail sales missed expectations as well, and it grew at its slowest pace since April of this year. Industrial production rose a little bit more than expected in October, but we're seeing some of the regional manufacturing gauges slowing their expansion. All right, so we're getting, the markets are starting to indicate a little bit of a slowdown in the expansion. It's still expansion, mind you, but a little bit of a slowdown. Okay, so we're seeing some of that too. And then finally, on the U.S. Treasuries, it's kind of a mixed economic outlook. The coronavirus spreading the number of cases, which I've always said, don't look at the number of cases, look at the number of percentage deaths to people that catch it, because we're clearly getting more people getting tested now. So it's going to drive the number of cases up. But it's pushed the yield on the benchmark 10-year U.S. Treasury note to its lowest level in 2 weeks. Okay. So we're seeing a little bit of that flight to safety there. The other thing is the municipal bond market had solid gains for most of the week. And that is primarily on the case that if Biden wins, the munis are going to do better, because the view is a Biden administration will be more apt to reward very poorly run municipalities with more money. Now, if they're held in check by the Republicans, if they maintain control of the Senate, then he's not going to be able to do that. So that's a little bit about what I'm seeing there from that perspective. So now let's kind of shift our view over and take a look at the market. So what I'm going to do is I'm going to shift the screen here. And let me come over here to this screen, right? All right, what you're going to see is the daily chart of the S&P 500 E-mini futures as soon as it comes on the screen here. And on this perspective here, you can see that, and let me just get this off the screen here from my perspective so I can move about. So what you're seeing here is the market's just showing some weakness. We hit the 2020 high. That was on the day that Pfizer announced the results. We actually went up 160 points during the day and then quickly sold off. So that does show that the markets are sensitive to this slowing economic expansion. I do not have any divergences here, so that does suggest that any pullback is going to be bought. You can see the 50 EMA sitting right around 34.41. I've got a key support area here at 35.41. We're in this S1 zone. That's a support level zone from 35.87 to 35.41. I do believe we can go a little bit lower. In fact, what I'm telling our members that if we break 35.41, we're going to come down to 3,500, possibly 34.50. I don't think I see much more downside than that. But it all depends on what kind of headline news we get with fiscal stimulus and the vaccine. But you can bet some good news will be coming out for emergency authorization of a vaccine probably within the next week. Now, I will remind everybody that next week is a big holiday week here in the U.S. markets. The markets in the U.S. are going to be 100% closed on Thursday and only open a half a day on Friday. So volume traditionally drops off dramatically Wednesday afternoon and extends through the end of the week. Friday is the traditional kickoff of Black Friday, but we've had a number of sales events online now, but we're still going to see the Black Friday event primarily online, but in brick and mortar stores as well. So there's a lot of low volume trading this week as we go into a long holiday weekend here. So this is kind of what I'm looking at here. You can see the 2019 close right here. So we're well north on the price. Now, if we look at the Dow futures, which is really bringing up the rear, you can see here that we did hit that high again on the vaccine announcement by Pfizer, the initial announcement, and then we've been selling off. But again, there is no divergences here. This is a valid move higher. I don't think we're going to fall too far before we catch our breath, possibly around this zone right here, right in the 28,845, 850 area there. So I think we're going to find some support here, and then we're going to move a little bit higher. Remember, November, the second half of November and all of December traditionally is a very bullish time for the U.S. equity markets, right after the Thanksgiving holiday period here in the U.S. So I think we can recognize a relatively strong finish into the end of the year. Okay, so that's kind of what I'm seeing. Even the equal weight S&P, you can see, is in the green year to date, which is more value. This is the S&P taking away the weighting of the large FANG stocks. Okay, so when you look at it, you can just see that we're here. Now, one thing I did want to point out was the Russell, as we're just getting really strong movement in the Russell futures, right? And if we look at it, you can see here the Russell futures hit its all-time high here on October the 9th. All right, just a couple of weeks ago, all-time highs, October the 9th. If we look at NASDAQ, you'll see here, let me just find it here on the screen. If we look at NASDAQ futures, you can see it hit its all-time high on September of this year. So quite a few months ago, and then we've just been kind of running in this long consolidation pattern here. I do believe NASDAQ is going to move up. I've got a target of NASDAQ around 13,004. I think when we take out the all-time highs that we made on September 2nd, we're moving higher in NASDAQ. And then, of course, if you look at the FANG, it'll be very similar. Here's the FANG, even more underperforming than NASDAQ 100. You can see the last all-time high was around the same as NASDAQ futures in September 2nd. Right here, and remember this special index that I have carved out here in eSignal is Microsoft, Facebook, Apple, Netflix, Google, and Amazon. So some of the main FANG drivers, right? And you can see we've been in this long consolidation period. Again, I think this is going to run much higher too. All right, if I were to just measure it, this uses a combination of Gann and Fibonacci extensions that suggest a really good strong number here as we go into 2021. Keep in mind, members, I will go through this and again in detail tomorrow evening. I'm expecting the markets running up through January, February, and then having a nice little pullback February and March and April. And then we'll have another strong run into the summer months. I'll show you the charts here in a bit. So that's kind of what I'm looking at. And of course, if we look at volatility, guys, you can see here the VIX into the shaded zone here, a little rose colored. We're in the red. Different option strategies take place in different colored zones in the VIX. You can see up here is Black Swan. But you can see the VIX is kind of finding support here. And until we get the election all complete and who's the final elected president officially certified, right now everybody's saying President-elect Biden, but until it's officially certified, there's no president. But you can see here the VIX is slowly starting to turn up a little bit, showing a little bit of cause for concern. And as I said before, with the extreme bullish sentiment by portfolio managers, remember when you get anything extreme in the markets, you can look for the opposite effect. Which would suggest the VIX is we're gonna have a little bit of a pullback here before we have a strong finish into the end of the year. Let me just understand that. And of course, if we look at the bond market, bonds were up, interest rates down. Look at the bonds; they've been slowly moving up since October the 11th. Over the past 10 calendar days, you can see bonds have been moving up, interest rates have been moving down. I don't think it's going to have too much life, meaning I don't think interest rates are going to come too low before they stop, consolidate, and move higher. If we look at the 10-year rate, you can see how it's been coming down. We've been in the upper boundary here, but I think it's going to find support very soon. Now, if we have a little bit of a pullback, which is where I think we could go, down to the 3450, 3500, short of any headline news moving event, then we can see interest rates come down a little bit lower before they consolidate and move back up again, right? I'm kind of seeing that. And again, if we look at the dollar, I have been bearish the dollar, and you can see my target for the dollar is down here on this colored bar, down around 91.11. All right, it's a dollar index, is not officially the dollar, which means other currencies relative to the dollar are going to be much stronger. And if we look at the euro, which is my favorite one right now, I am bullish the euro. I think the euro is going to run up to 121, 122 to the dollar. And bull put spreads underneath the euro make a lot of sense to me, or unbalanced flies in the options market make a ton of sense to me. Members, we may even put one on in our secret trader for this week. I just like it. And I think it's going to run up even more. It's going to surprise people. The other one that's going to surprise people is the British pound. If we take a look at the British pound, you can see how it wants to run bullish. I think we may have a little bit of a pullback here, but just use that as a buying opportunity for the pound. All right, that's kind of where I see us heading. And then, of course, if we come over here and we look at gold, gold is in a sideways long consolidation pattern. All right, it's almost like a cup and handle, but we're still in the middle of forming that cup or that saucer. You can see this long drawn out. I don't believe we're going to see gold moving much higher than the 1990 2000 level until we get into February, March time frame, maybe April time frame of next year. For now, gold is just a day trade or an iron condor type of trade or a steady as she goes butterfly type of trade. All right. But other than that, I wouldn't touch it. Same thing with silver. Copper, however, is our trade of choice in the metals market. And you can see we got into copper back over here. It was our members jumped in. We had a number of members trading copper futures, and it's just a home run trade. You can see it's now coming up. It's testing this. It may pull back a little bit, but our trade of choice, if you couldn't trade the copper futures, was Freeport McMoran. All right, and that one is Foxtrot Charlie X-Ray. And you can see here, it is just, we got into this, or in the low sixes. Now it's 21.25. We're going for a 4x return on this, even more. I can see it up to 24 up here, and I think it can still run even stronger. All right. So I just see copper is a play on a return to global normalcy, global expansion, infrastructure build out. Remember, China could be the only major country GDP that finishes in the green for the year in 2020. And China is a big supporter of being long copper. So again, this is just going to be a really good one for us, and I think it's just going to play out very nicely. Oil, as I said, has been bullish. And if you look at it, right here, let me just blow it up. You can see here that it's just in this wider range, which I love range bound trades in oil right now. I don't think it's going to get much more than 45. It's not going to penetrate this bar down below. So 35 to 45 is the range. Doing flies or iron condors, if you know how to adjust them, it's a fairly easy income producing trade for now. All right, it's going to change, but for now, at least through January, you do not want to trade oil during any OPEC meeting, because oil has a tendency to get very nervous around any kind of thing that OPEC does, and naturally so. But for now, I think it's a good income producing trade. Nat gas, well, nat gas, as you can see, we did not get a signal to go short up here. I was looking for one. We didn't get it. It pulled back below the 50 EMA. I'd love to see it run a little bit higher, and any rally here with nat gas should be sold off. I think nat gas is slowly going to work its way back down lower longer term. All right, so that's just kind of where we're sitting there. Okay, guys, those are the major markets. Members, this Sunday evening, we'll go through some stocks that I see, equities that also look good, along with some really interesting plays that we currently have on, plus new ones that we're looking at. If you're not a member, I highly encourage you to come in and check us out. We're having a great year, and I think next year is going to be even better. There's going to be some huge opportunities in 2021 that are shaping up. All right, everybody, have a really great weekend. Members, I'll see you this Sunday evening for our weekly market watch. Take care, folks. Ciao now.